Hello, this is Dr. Oz. In this video, I would like to talk about the free cash flow and the intrinsic value of Apple. First of all, what I would like to do is I would like to create this part right here. So I don't think the previous video you had discount rate. So what I did is under 12, right click on that and click on right click on 12 and insert, and sorry, just let me just Control Z. I want to just create insert on the 13, insert right here, and call this one as discount factor. All right, so what I'm gonna do here is that for the base year, which is 2019 in this case, discount factor will be 1, number 1, which there will be no discount for today's dollars. But then I will multiply this value by 1 minus my discount rate that I calculate for VAC over here. That will give you a discount factor for a given year. All right, so if I just drag it all the way, so for year 10, press F9 to refresh your calculations. The dollar that you receive in 2029 is worth only $37.42 at the end of year 2019. All right, so now next thing I would like to do is I would like to calculate free cash flow growth rate. Free cash flow growth rate that based on my forecast that I calculated. So how am I going to do that? This is going to be 1 plus the revenue growth rate estimate times 1 plus EBIT or profitability change estimate right here. Okay, and when I press enter, I got this value right here. Once again, though, this is I need to subtract 1 to calculate percent change. Probably your numbers are different. Please don't freak out right now because I made a change over here. So if you just look at this, define assumptions. If I click OK, this is a number that probably you are seeing in your calculations, which is, let me just change back to what you guys have. All right, so now when I press F9, you can see that the growth expectation for Apple is 26.7%, which is very, very, very high. So that's not probably reasonable. Maybe Apple can increase a year or two 26%. However, that's not sustainable. The reason is that because this future cash flow growth rate estimate is based on revenue growth rate and EBIT changes, but those numbers can get extreme values. And to eliminate that, I will show you a couple tricks. So I will first start with the revenue growth rate and then click on define assumption here. And this is the growth rate assumption. It can go to all the way down to as negative as -80%. It can go all the way up to over 100% in 1 year increase, which I don't think it's logical. If you just go to income statement and look at the last year's revenue change, I see decrease in -2%, increase in 15%, as low as negative 7.7%, as high as increase in 60%, 50%. However, what I would like to do is I would like to put a ceiling and floor. So the ceiling is I'm going to use the latest recession we had and the recovery. At that time, Apple's revenue increased 52%. Okay, so now maybe I can, I mean, I see that there are higher numbers here, like 65%, but I would like to cap it somewhere around 50 to 65%. So let's put a cap of 55%. Again, this is my story. If you don't like my assumptions, you can always make your own assumptions. I will cap my growth rate annual basis at 55% based on these recovery numbers. And then I look at the revenue went down minimum 7%. So I would just floor it at negative 10%. Okay, what do I mean by that? So I will go back to my valuation and this green cell, define assumption. What I'm gonna do is I will cap my, you see here, I will just drag this one till I see truncate to negative 10%. Okay, negative 10%. I don't think Apple's revenue in next 10 years will go down more than negative 10% per year. And upper bound, I would like to put truncate again at around 55, as I discussed with you, 55%. So these are my assumptions, okay? Please make your own assumptions and click enter and click OK. So now this, although this increase my even average more, however, it will change my distribution so that my results will be different. I'm just trying to eliminate the possibility of crazy extremes that can cause big problems in terms of valuation. So now I will copy this new cell, a crystal ball copy, highlight this area, crystal ball paste. All right, so now I will do similar thing for EBIT change. When I go back to my income statement, you can see, scroll down, you will see EBIT change to be calculated here. And again, EBIT change, I don't think it should go so crazy high and low. And again, you can make your own assumptions. There are some crazy years like that that can change so much. To eliminate those craziness, what I will do is, I would say the efficiency cannot increase more than 20% or decrease more than 20%. How am I gonna do that? So I click on the first entry here and then write an if statement. If this value that I calculated, let me copy this value, Control C. If this value is greater than 0.2, which is 20%, then give me 0.2. Don't give me more than 0.2. Otherwise, nested if, another if that calculation, Control V, is less than negative 0.2, 20%, then don't give me less than negative 20%, give me negative 20%. Otherwise, give me the value itself. Control V, close parentheses again. So now what does it do? As you see, so now if I drag this one right, this number should not change. This number should go down to negative 20. Let's see whether that's the case. Press F9. Okay, that number did not change. This number should go to negative 20. All right, and this number should stay 7%. And when I copy this formula to the right, this number should go to negative 20. And this number should go to positive 20. See, this is positive 20, negative 20. So I'm capping those values. I will drag this one all the way till the end so that I cap my values. Press F9 to refresh. All right, so now when I go back to my valuation and click on this assumption and define assumption again, now you will see that I don't have those crazy values anymore. I have negative 20% is minimum, positive 20% is maximum. So I click OK. Now that changed my average, obviously. And now crystal ball, I will copy that and then paste it right here. Perfect. So now what I can do is I can refresh my model, F9. So you can see that my growth rate expectations are around 17%. So that's more logical than 26%. And also, again, it's not only impacting average, it will impact the crazy high and crazy low numbers. Perfect. So now I can calculate my free cash flow, okay? Free cash flow. So what's free cash flow? Crystal ball gives me, not crystal ball, the, what's the software package? I'm going blank. Capital IQ gives me the free cash flow. So I will go to cash flow statement and then I will scroll down. You will see here levered free cash flow for the most recent 10K is $42.9 billion for Apple. Okay, so now I have a disagreement with this number. Why? So when you go to Capital IQ and click on the cash flow statement, one thing that's good with Capital IQ, that if you don't know any of these terminologies, you can click I symbol right next to it to figure out what it is. So I'll scroll down under cash flow statement. You see this levered free cash flow. When you click on that, it shows you how it calculates. It's based on EBIT. It considers the tax shield effect based on tax statutory rate, which I cannot pronounce, and then interest expenses also has tax shield effect that should be added back, and depreciation is not a cash flow that should be added back. Amortization of the deferred charges also is not a free cash flow that should be added back to the free cash flow calculations. However, capital expenditures are real cash flows; they need to be subtracted, and we need to consider change in working capital. That way we can calculate, generate more free cash flow, and so on. So I like this idea, but when you look at the statutory tax rate, they assume it's 37.5%. But when I look at the American or world average tax rates, is around, for America is on 21% cap, and in the world weighted average based on GDP is around 25%, 26%, 25%. So I'm going to use 25% for the statutory tax rate. So that's why there's a difference between my number 25% versus Capital IQ number is 37.5%. The difference is 12.5% for EBIT and interest rate. That's why interest expense, I need to add that back. All right, how am I gonna do that? Let's go back to my model. So I need to add to this calculation. Again, 0.375 is their assumption, and mine is 0.25 tax rate. The difference is 12.5% times, I will consider EBIT from income statement for the most recent data, 2019, which is right, operating income right here, $63.9 billion, and also interest expenses, net interest expenses right here, $1.3 billion. They both have the same situation. So tax shield effect. So that's why I put them all together and multiply with that. So according to my estimate is $51 billion free cash flow that Apple generated in 2019 versus their calculation 42. It's like $9 billion, quite a bit of difference. So please use this number, this calculation for your company. All right, now based on this base year, I can calculate the forecasted future free cash flows by multiplying that value by 1 plus the rate itself. Okay, so once I do this, what I'm gonna do is I will click on dollar symbol right here, and now I can drag it all the way to the right. Okay, these are, press F9 to refresh. You can see that these are my free cash flow estimates for the future. These are on average. Of course, these are random numbers. These are two. And based on these random numbers, these results will change. Now, I need to calculate the present value of those future cash flows, future free cash flows. All right, so how am I gonna do that? So I will start here, year 2020. I will divide my free cash flow, not divide, sorry, multiply by the discount factor that I calculated right here. Constant time value of money, and I will drag it to all the way to the right. Okay. However, for the final year, terminal year, I will assume that this free cash flow in year 11, basically, or year 2030, will continue growing with the rate of 2.5% perpetually. So how am I going to do that? You will divide this value by your WACC right here minus your free cash flow growth rate times discount factor for year 11, which is right here. So the terminal value you can see here for this company, Apple, is $1.4 trillion on average. All right, now this is the enterprise value. This is not the intrinsic value yet. So now I need to consider the total debt, and then I need to consider cash, and I need to consider intrinsic. I can calculate intrinsic value of the equity, right? Of the equity. All right, so the total debt is given in balance sheet for in Capital IQ. You scroll down, you will see total debt, most recent year. Right here, $108 billion. All right, now I need to also look at the cash that they have in balance sheet. Cash and cash equivalents, we have right here, $48 billion, okay? Actually, you can use $100 billion here because the short-term investments are pretty much cash, okay? You can just sell them and convert it to cash. All right. And now I can calculate intrinsic value of Apple by summing up all the present value of these future cash flows, expected future cash flows, minus the debt plus the cash. So you can see that according to our calculations, Apple's intrinsic value is $2.2 trillion on average. So now what I would like to do is I would like to calculate intrinsic value per share. Per share. All right, basically I need to divide the intrinsic value by number of shares outstanding, which we have it, I think income statement. When you scroll down, you will see here that the total number of shares outstanding is right here, with average basic shares outstanding. When I do that, you can see that on average, I think the intrinsic value of Apple is around $437. But again, that doesn't mean anything, right? Because this is one single number. We know there are distributions, and I will not run my model. To do that, I need to first define my forecast. So this is my forecast. All right. Now I would like to run my model for 1,000 simulation trials. And now you can see that my simulation is running. And okay, so now what am I gonna do? So what I'm gonna do is I will look at, first of all, view the statistics, and on average looks like Apple, according to my calculation, is worth $470, $77, and median $405. Again, doesn't mean anything, not really. So what I'm gonna do is I will look at my, again, frequency, and I would like to look at the value value that I think of Apple. I want to have 90% accuracy. Again, everyone's risk tolerance is different. So when I put this one around 90%, right here, somewhere around here. All right, so around 90%. So you can see that the maximum I will pay for Apple is 198, 197, whatever dollars. Let me just put 198. Okay, $198. With that, if I pay $198 per share for Apple with 90% accuracy, that I know the value is greater than 198, so it's a good buy. Let's take a look at now, like Warren says, first calculate intrinsic value, then look at the stock price. If I look at Apple's stock price, currently it is $247, although this number decreased from all the way down from $324, and it went down to actually 224, the lowest. So let's take a look at current price, $247. Is it a good buy? $247. If I plug here $247, basically you can see that probability that the value of Apple is greater than $247 is 81%. Is it good? I don't think it's bad at this price, but I wish it was around $200 and $198 that I will have higher confidence about my decision of buying Apple. So what I'm gonna do is one last thing. I would like to create a report from this. It's what I want you to do as well. Create a forecast report for Apple analysis, and you can see number of trials, confidence interval. You can see the graph. With $247, there's 81% chance of having higher than that. You can see that mean and median values for Apple is pretty good in comparison to price, and standard deviation is very, very high. So it's one thing to point out that the numbers, it's again, stock market in general is hard to predict, and that's why this is not an exact science. That's why value investors want to see a great deal of great level of margin of safety, which I talk about. I want to pay not more than $198 or $200 per share, because that's my margin of safety, that 90% chance of making money out of this deal. So you can see the 10 percentile here. It's what I'm talking about, that this is the buy price for me. And what's the selling price for Apple? I mean, so hard to say, but I would say I wouldn't sell Apple if I were owning it until, I mean, probably I wouldn't sell it for, unless I have a better option, but maybe $843, which is an insane number. I know that. But if you buy a stock, your idea is to keep it forever, unless you have a better idea of buying something else. That's it for this video tutorial. Until next video, enjoy business analytics.